You might ask, the Fed is buying $2 trillion worth of securities. How do we pay for that? The answer is that we paid for those securities by crediting the bank accounts of the people who sold them to us. And those accounts at the banks showed up as reserves that the banks would hold with the Fed. So the Fed is a bank for the banks. Banks can hold deposit accounts with the Fed essentially, and those are called reserve accounts. And so, as the purchases of securities occurred, the way we paid for them was basically by increasing the amount of reserves that banks had in their accounts with the Fed. Figure 32 shows the liability side of the Fed's balance sheet. Of course, assets and liabilities, including capital, have to be equal. So the liability side had to rise to nearly $3 trillion, as you can see. As you look at this, look first at the bottom layer, which is currency, for the reserve notes in circulation. Sometimes you hear that the Fed is printing money in order to pay for the securities we acquire. But as a literal fact, the Fed is not printing money to acquire the securities, and you could see it from the balance sheet here. That layer is basically flat. The amount of currency in circulation has not been affected by these activities. What has been affected is the layer above that, reserve balances. Those are the accounts that commercial banks hold with the Fed, assets to the banking system, and liabilities to the Fed. And that is basically how we pay for those securities. The banking system has a large quantity of these reserves, but they are electronic entries at the Fed. They basically just sit there. They are not in circulation. They are not part of any broad measure of the money supply. The money supply. They are part of what is called the monetary base. That's right, but they certainly are not cash, not cash in circulation. Then the top layer is other liabilities, including treasury accounts and a variety of other things that the Fed does. We act as the fiscal agent for the treasury, but the two main items you can see are the notes in circulation and the reserves held by the banks. So what do the LSATs or the quantitative easing, what do they do? We anticipated when we took these actions that we would be able to lower interest rates, and that was generally successful. For example, 30-year mortgage rates have fallen below 4%, which is a historically low level. Wouldn't it be the case if they didn't LSAT, didn't do this LSAT? All right. But other interest rates have fallen as well. The interest rates corporations have to pay on bonds, for example, risk premium. Yes. So the interest rates corporations have to pay on bonds, for example, have fallen, both because the underlying safe rates have fallen, but also because the spreads between corporate bond rates and treasury rates have fallen as well, reflecting greater confidence in the financial markets about the economy. And the lower long-term rates, in my view, and in the Fed's analysis, have promoted growth and recovery. Nonetheless, the effect on housing has been weaker than we hoped. We have gotten mortgage rates down very low. You would think that would stimulate housing, but the housing market has not yet recovered. The interest rate, both because the underlying safe assets have fallen, but also because the spread between corporate bonds rates and treasury rates have fallen as well. This is important part, reflecting greater confidence in the financial markets about the economy due to the asset. And lower, so it's about confidence about the Fed, not the economy. And the lower long-term rates, in my view, and the Fed's analysis have promoted growth and recovery. Nonetheless, the effect on housing has been weaker than we hoped. We have gotten mortgage rates down very low. You would think that would stimulate housing, but the housing market has not yet recovered. Then, when the lecture was going on, the Fed has a dual mandate. We always have two objectives. One of them is maximum employment, which we interpret to mean trying to keep the economy growing and using its full capacity, and low interest rates are a way of stimulating growth and trying to get people back to work. The second part of our mandate is price stability, low inflation. We have been quite successful in keeping inflation low. It has been a help that Volcker, in particular, and also Greenspan, made it much easier for me because they had already persuaded markets that the Fed was committed to low inflation, and the Fed has built up a lot of credibility over the past 30 years or so. As a result, markets have been confident that the Fed will keep inflation low. Inflation expectations have stayed low, and except for some swings up and down related to oil prices, overall, inflation has been quite low and stable. At the same time, while we have kept inflation low, we have also made sure that inflation has not gone negative, particularly around the time of QE2 in November 2010. There was concern that inflation had been falling. It was well below normal levels. The concern was we might get into negative inflation or deflation. Deflation has been a big problem for Japan's economy now for quite a few years. And I talked about deflation also in the context of the Great Depression. We certainly, did I read that? We certainly wanted to avoid deflation, so monetary ease also guarded against the risk of deflation by making sure that the economy did not get too weak. One more comment on large-scale asset purchases. A lot of people do not distinguish between monetary and fiscal policy. Fiscal policy is the spending and taxation tools of the federal government. Monetary policy has to do with the Fed's management of interest rates. These are very different tools, and in particular, when the Fed buys assets as part of an LSEP or QE program, this is not a form of government spending. It does not show up as government spending because we are not actually spending money. What we are doing is buying assets, which at some point will be sold back to the market, and so the value of those purchases will be earned back. In fact, because the Fed gets interest on the securities we hold, we actually make a very nice profit on these LSEPs. What we have done over the past 3 years is transfer about $200 billion in profits to the Treasury. That's about 10% profit. That's amazing. Then money goes directly to reducing the deficit. So these actions are not making, not deficit increasing. They are in fact significantly deficit reducing. So a major tool we used when we ran out of room to lower short-term interest rates was LSEPs, asset purchases. The other tool we have used to some extent is communication about monetary policy, to the extent that we can clearly communicate what we are trying to achieve. Investors can better understand our objectives and our plans, and that can make monetary policy more effective. The Fed has taken a lot of steps to become more transparent about monetary policy to try to make sure people understand what we are trying to accomplish. For example, 4 times a year after 2-day FOMC meetings, I give a press conference and answer questions about monetary policy decisions. This is a new thing for the Fed in terms of trying to explain what our policies are. 2011, 2012. I forgot again.